What this chart is showing is that commodities do well in both big deflation and big inflation. Hi, this is Mike Maloney, and I've got a special guest, Ronald Stöferle from Incrementum AG. He's back with us to go over their annual In Gold We Trust report. They came out with one recently, and it's a big one, and there's a lot to cover in these. So this is going to be several videos, and we've got one that's just about silver, and this is the very first time that they've done a whole chapter on silver. Ronnie, how are you doing?
Very well. Thank you very much for having me again, Mike. Yeah, it's always a big relief to get the report out. It's like my wife doesn't like the comparison, but it's like delivering a baby. It's it's lots of work, but we're just overwhelmed with all the positive feedback from all over the world.
What I'm amazed at is that it's really, this is a book. How many pages is the whole report?
350. But there's also a compact version, which is still 100 pages.
Okay, so let's get into your report. And I'd like to, we were talking earlier, and down on page 13, there's the commodities index divided by the stock market, basically. So it's real stuff divided by paper stuff. So could you just go over this chart and give us your thoughts on it?
Yeah, well, I mean, it shows the Goldman Sachs Commodity Index versus the Dow Jones Industrials Index. And it's a ratio. And as you know, Mike, we really enjoy long-term charts because, there's so much fuzziness in markets nowadays, and there's so much monetary intervention. And I think that those long-term charts and especially ratios give you more information than absolute charts and only short-term charts. So what you can see on this chart is since the year 1900, actually commodities were only once that undervalued versus the stock market. And that was in the 1960s until the beginning of the 1970s. And we know what started afterwards. And I think, first of all, it's a sign that commodities probably are the most contrarian investment that you can make at the moment. I know that if I would attend a conference now and I would say we're bullish commodities, yeah, we're buying commodities for our funds, people would ridicule me. It's very similar to, let's say, 1 year or 1.5 years ago when I said I'm bullish gold. People said, come on, gold, it's ridiculous. Nobody cares about gold. So that's already a good sign. And I think that all great investments, they begin in discomfort. So they have to kind of hurt to be really good investments. When it's obvious and when everybody says, yeah, that's a great call, buying Facebook, buying Google now, it's such a great idea, then you have to become a bit more cautious. Now, what you can see on this chart is that, first of all, we're trading at very, very cheap levels compared to the stock market. And we can see that we're way below the median. So, one of the iron laws of financial markets is the mean reversion. So I think that we will go back at least to the median, which would be 0.46. And at the moment, we're trading at 0.1. So I think there's lots of upside.
So you think there's about 5 times gain at minimum of commodities against paper assets?
Yes, I think that's not impossible. And if you follow this chart, you can also see that reversals most of the time also meant a reversal in the US dollar. So of course that would also coincide with the weak dollar. And many people say, okay, so where should interest for commodities come from? And my answer is, first of all, nobody's invested in commodities at the moment. Nobody cares about it. And the second thing is, just open the newspaper. You will see massive amounts of fiscal stimulus flooding into infrastructure programs. That's basically it, how governments and politicians all around the globe will try to solve this crisis with very Keynesian measures.
Economics.
Exactly. So there will be, I don't know if they're gonna call it Marshall plans or new deals or whatever. Those measures, I think they will be very stimulating for the commodity space, which is at the moment probably the most hated asset class. So I think there's, the risk reward picture for commodities is fantastic. And we always said, first, it is the gold market that starts moving. We already saw that, so we can tick that box. The second market is the silver market. Now, we saw this massive spike in the gold-silver ratio up to 125. Now we saw the reversal. So silver started outperforming gold. So we can tick that box as well. And the third stage is always commodities going into a bull market. And I think, if you have a look at copper prices, for example, other base metals as well, I think it looks more and more constructive. So I feel pretty confident that commodities will prove to be a really good investment going forward.
I think you're right. I've got a couple of comments here. In my book, I dedicated a whole chapter to trying to teach the difference between price and value. And you cannot see true value when you're measuring things with dollars. When you measure stuff against stuff, like this chart, the ratio chart. So it was a whole chapter on just ratio charts of everything. And I actually broke down the commodities index, the stock market, which was in a bubble back then, against things like the commodities index, but I drilled deeper: oil, the industrial metals index, the agricultural index, so the components of the commodity. And there really wasn't anything that you could use except the dollar. Everything proved that the stock market was in this hyper bubble again, except the dollar. If you measured it with dollars, the stock market looked okay. But the thing that I love about these charts is that this is something where, my whole investment strategy was, or is, to find something that's incredibly undervalued on these long-term charts that nobody trades these things. So if you take a position in something that's incredibly undervalued historically, and if it goes down a little bit further, you don't have to, I think we're going into this deflationary dip. So I do think that commodities will do one last pullback. But then we're going into either big inflation or hyperinflation after that. I don't know how long this will take to play out, but what I love about charts like this, you can just, that you can take a position and just wait. And if it goes down, you don't have anything to worry about. You can add to your position. That's what I've been doing with gold since the year 2002. I first saw my Dow Gold ratio chart back in 2002 or 2003, and I was able to just take a position with absolute confidence and not worry about it and not get shaken out of my position. I just use the dips. When gold falls, I'm going, all right, it's down again. I can get more. But one of the things that I noticed here is usually, like if you go back to the year 1930 on this chart, and you look at where it went from that extreme undervaluation, commodities went big time. So your gains were absolutely enormous. Here we've got a factor of close to 6. It's about 5.5. The more undervalued I see these charts as like a pendulum swinging back and forth. And if it's a little bit undervalued, it's going to go a little bit overvalued, but a lot undervalued, it's going to. So the likelihood of a swing up to that 1.0 area is huge. Where is it at currently?
It's 0.1, I would say. It's the same levels like in the end of the 60s.
So you're talking a 10 bagger, and this is a broad index. If you pick the right things out of this broad index, you could get a 20 bagger or more. For the audience, a bagger is how many times your winnings are over what you invested. So I think that this is an amazing chart. showing the overvaluation of paper assets compared to real stuff. And we've had a century of overvaluation of paper assets. The interesting thing is how smooth the trough is in the 60s. That's when the stock market did an invisible crash. It went up into a bubble in 1966 and then just went sideways. And then, but it went sideways until 82, basically. So the middle of this chart is when commodities took off during the Arab oil embargo, during the period where the US dollar was disconnected, when Nixon took the world off of gold, when he ended the Bretton Woods system. So those two things, oil and gold, drove the reversion in this chart, and they may once again. So anyway, any other last comments on this chart before we move on to the next one?
Well, I think it's also, of course, it coincides with inflation, and from my point of view, inflation is perhaps it's not around the corner, but it is on the horizon. And I think, you know, with all the debt creation that we saw, I mean, those numbers are just staggering. And at the moment, I think it's, we crunched numbers until end of April, and it was 23 trillion US dollars fiscal and monetary stimulus. So roughly 20% of world GDP. And we always said, you know, after the corona crisis, the health crisis, we will end up in an economic crisis and probably in a debt crisis. So we know how debt crises normally get solved. And I think we will see hugely negative real rates, not only for the next years, but also for the next decades, probably, if not a monetary reform. So I think that, you know, higher inflation rates, because now we are seeing that control over the money supply is being passed from central banks to governments. We're seeing more closer interaction between central banks and fiscal policy, stuff like MMT, helicopter money, universal basic income, whatever. I think this will have a much more direct inflationary consequence. And therefore, I think
it will, but what I see in this chart when I look at it, you know, I'm looking at the 1920s, and you see that during the Roaring 20s, from about 25, this is falling, even though, and that really wasn't a big inflationary period. But then in 29, it continues its fall, and that's because the stock market crashed, and then you see the commodity, the stock market crashed from 29 to 32. So it goes up during that period from 29 to 32 is the huge spike there. So it's basically the stock market falling, even though commodities, they were trying to get, you know, Roosevelt had all of these policies of trying to boost agricultural prices and stuff to help the farmers. So he's trying to make food more expensive for people during the Great Depression. It was insane. And they were actually paying. They were taking tax money from productive businesses and individuals and paying farmers to plow under their crops, to not plant things, to try and get the prices of them to go up. It was totally insane. And this is what happens when you've got central planning of an economy, and it just made things worse. This is one of the things that caused the Great Depression. It was just a stock market, but this chart shows it so dramatically, and you know, it's whatever is moving the most that causes the big gyrations in this chart. And back then, it was stocks falling more than it was commodities rising. In the 70s, it wasn't stocks falling; they went sideways all 70s. It was commodities rising. And so, but what's interesting is when you take the dollar out of the equation. So what this chart is showing is that commodities do well in both big deflation and big inflation. It's only when things are just going along with everything in balance and perfect that commodities don't do well. And we are not in one of those times right now. We're in a time where everything is crazy. And so commodities should I mean, this chart is showing that this is an area where you can take a position and just wait and don't watch it every day and don't get scared out of selling your position when it takes a little temporary dip, because the dip is temporary and this chart is guaranteeing that for you. That's what I'm sorry I interrupted you.
No, that's fine. I think, you're right. But if you have a look at stocks in the 1970s, basically 66 until 82, on a nominal basis, they did okay. But on a real basis, it was a horrible performance. Yeah, absolutely. So it was
the second largest crash after the 1929 stock market crash.
Yes.
Measured on a percentage of losses. Even though the stock market just went sideways, the Dow bumped its head on 1,000 points and couldn't get through for 16 years. And during that time, though, we had raging inflation. So I believe that the amount of losses adjusted for inflation is like it's in the high 80% range. It's not the it's very close to what the Great Depression brought up. Not the Great Depression, but the stock market crash of 29 through 32. Well, that wraps it up for this video. Ronnie, this was great. Such an in-depth dive into commodities versus paper assets, because paper assets have really been in a bubble for this entire century by all of the other measures. The stock market and bonds are just, to me, totally insane. And so it'll be interesting coming back to this next year when you come out with your next big report like this. So we're gonna, I'm gonna see you in the next video. I want to thank you so much for being here.
Thanks a lot, Mike.
Okay, we'll see you next time.